Yeah, you found.
Yeah, exactly. So
tell them about the deal. It's a 4-bedroom house for $500,000.
Yep, I found a 4-bedroom house, and I'm renting it for $2,900 a month. And I actually think I could have got more, but I just bought it, so I want to get someone in right away. I think I could have got like 31, or because I had so much interest at 29. But at the end of the day, people like to wait to buy because they're uncertain about what's going to happen with the market. But the way that I look at it is like, I bought a deal 3 years ago. It's worth a little less than I bought, probably like 10 grand less than I bought it for. But in the past 3 years, I've collected over $100,000 in rent.
Yeah. It's amazing.
So, you have to offset that to some degree, like you can wait, but you also don't know when the bottom of the market is.
So I want to talk to you about this and how to navigate it, but we got to take one quick break. We'll be right back.
Most investors focus on returns, but the real lever is what you keep after taxes and how flexible your capital is along the way. That's where FREC takes a different approach. With direct indexing, you're not just tracking the market, you're actively harvesting losses across your portfolio to help offset gains and reduce your tax burden over time. But here's where it gets interesting. Instead of selling assets when you need capital, FREC also offers a PLOC, which is a portfolio line of credit, so you can borrow against your investments without triggering taxes or disrupting your strategy, with no credit check and no strict monthly payment schedule. So you stay invested, you stay tax aware, and still have access to liquidity when opportunities show up. If you want a more efficient way to manage both taxes and access to capital, check out FREC and schedule a free portfolio analysis.
Welcome back to the Bigger Pockets podcast. I'm here with Ken and Danil McElroy. We're talking about multifamily, single-family market, how things have changed since 2008. And let's start talking about opportunity, because I think that's what people are excited about right now, is that pricing's getting a little bit better, affordability is getting a little bit better. So, Ken, we were talking, kind of joking before that, the situation we're in right now, not great if you're holding assets, good for buying assets, but you do both. So how are you sort of thinking about portfolio level strategy?
Sure. So I think it's important that I'm a fixed rate guy, right? I think you should always hedge your biggest expense. That's your biggest expense. Fix it, and make sure it cash flows day one, period, right? So that's been my philosophy from day one. That's why we never got in any trouble. I don't buy anything with an expectation that rates are going down, ever. I always actually think they're going up no matter what. That's where my head is.
I like that.
And I'm like, if they go down, great. But if they go up, then I'm hedging. And our whole portfolio, the other thing is we're under 60% loan to value on our whole company.
Amazing.
We have some in the 30s, some in the 40s, some in the 50s. We have a few in the 70s, but not many, right? So I like loan to value, and I like fixed. And then we have our in-house management. So when I look at the blood in the streets right now, and it's a lot. What I see are I find low occupancy, I find poor operators, I find high expenses, I find stress, I find high expensive debt. All of that stuff disrupts multi. So I'll just give you a couple examples. 2 weeks ago, we looked at a deal in Texas. I won't say what city. 5% occupied.
What?
What
class?
200 B. 278 units. Now here's the interesting thing. It was worth $45 million in 2021, and so it's like a B minus. But they had dumped like $5-6 million of rehab money into it, and it's got a like $29 million loan on it, right? And we just made an offer for $8 million to the lender.
No, it's a lender.
Yeah. So now, am I seeing those deals every week? I am not. But I just looked at another deal in Kansas City, very poor occupancy. So what you have is this stress happening, and we're dealing with the people that own the debt, right? And usually it's coming from a broker, and sometimes the syndicator's involved, sometimes not. But so I think we're at the beginning of. And we might not get those two. Certainly we made offers on both, but this is what I'm seeing. I'm not talking about, 92, 88, 85% stuff. I'm talking about deep discounts. I'm talking about 2008 prices.
That's unbelievable.
Yeah.
I imagine